At some point, someone always asks the same question. If governments are in so much debt, why don't they just pay it off? It sounds reasonable, responsible even. You earn money, you owe money, you pay it back, debt goes away. That logic works in your life. It does not work for governments. And the reason why is uncomfortable. Not complicated. Uncomfortable because if governments tried to behave like households, the system would break, quietly at first, then all at once. Right now government debt is at record levels across the world. The numbers are so large they barely register anymore. Trillions, tens of trillions. Figures so abstract they lose emotional weight. But this matters now more than ever, because inflation, interest rates, elections, and social pressure are all colliding at the same time. And the old explanation, "we'll deal with it later," is starting to sound thin. So let's strip this down to first principles. No ideology, no drama, just how the system actually works. Start with the comparison everyone makes. A household borrows money. It does this because it doesn't have enough today. But the goal is clear. Pay it back. Be done. Debt is temporary now. Imagine if a household never planned to fully repay its mortgage. Instead, it kept refinancing it forever, rolling it over, extending it, sometimes increasing it. That sounds reckless. For a household, it is. For a government, it's the foundation of the system. Here's why. When a government borrows, it doesn't borrow from some vague market. It issues bonds. IOUS. Those bonds are bought by banks, pension funds, insurance companies, central banks, and investors all over the world. And here's the key point most people miss. Those buyers don't want the government to stop borrowing. They depend on it. Government bonds are not just debt. They are the backbone of modern finance. They are treated as the safest asset in the system, often safer on paper than cash itself. Banks are required to hold them. Pension funds rely on them. Central banks use them as tools. Entire balance sheets are built on the assumption that government debt will always exist. So what happens if a government decides to pay it all off? First, it would need massive budget surpluses, not just for a year, for decades. That means higher taxes, lower spending, or both. On a scale large enough to drain money out of the private economy, growth would slow, recessions would deepen, political pressure would explode. But that's just the beginning, because paying off debt doesn't just reduce liabilities. It destroys assets. Every bond the government retires is a safe asset, removed from the system. Banks lose collateral. Pension funds lose predictable income. Markets lose reference points. Liquidity dries up. Ironically, trying to be responsible creates instability. This is the uncomfortable math. Government debt isn't just about what governments owe. It's about what everyone else owns. When politicians talk about cutting debt, they rarely say whose assets they're cutting, because the answer is everyone's. There's another layer that makes this even stranger. Unlike households, governments that issue their own currency don't need to earn money first. They create the currency the debt is denominated in. That doesn't mean debt doesn't matter. It does, but it changes the nature of the constraint. The limit isn't running out of money. It's inflation, credibility, and trust. A household can default and disappear. A government can't. If it defaults, the financial system absorbs the shock. Banks wobble, currencies weaken, trade slows, confidence cracks. So instead of paying debt off, governments manage it. They roll it over, extend maturities, let inflation quietly erode its real value. Debt shrinks not because the number goes down, but because the money measuring it becomes worth less. This is never advertised as a strategy, but it's been used repeatedly. It's quiet, politically safer, and harder for the public to trace directly. Now compare this to how debt is discussed publicly. You hear phrases like living within our means, maxing out the national credit card, burdening future generations. These metaphors are powerful and misleading. They frame government finance as a moral household problem. Spend less, pay back, be disciplined. But governments aren't households. They're closer to system managers. Their debt is someone else's stability. This creates a permanent tension. Reduce debt too aggressively, and you risk collapse. Ignore it completely, and you risk inflation and loss of trust. So the system drifts forward, rolled over, extended, managed, not solved. This is why every promise to eliminate the debt quietly disappears after elections. Not because politicians are lying, but because the promise itself misunderstands the machine. The real question governments face isn't how do we pay this off? It's how do we keep this sustainable without triggering backlash? That's a much narrower, colder objective, and it explains a lot of modern policy decisions. Why austerity is delayed, why inflation is tolerated, why central banks step in during crises. Stability is prioritized over closure, continuity over resolution. Zoom out, and this reveals something deeper about the global economy. We've built a system that requires permanent debt to function, not reckless debt. Managed debt. Debt circulates. Debt that anchors expectations. Debt that gives markets something to lean on. That doesn't mean collapse is inevitable, but it does mean the debt is never meant to disappear. So when someone says, why don't governments just pay it all back? They're asking the wrong question. The better question is quieter and harder to answer. If the system needs debt to survive, what happens when trust in that debt starts to fade? And how do you fix a system that was never designed to end?